Good evening, guys, and welcome to today's class. Today, we'll be looking at risk management, position sizing, and portfolio management. In reality, all these two are actually a subset of this, meaning under risk management, you have these two. Now, what is risk management? Risk management simply implies controlling or limiting the extent of the damage that can be done to your trading account. So it is the steps, procedures, or techniques that you use to reduce the damage or to reduce the loss, the magnitude of loss that could happen to your trading accounts in case the market doesn't follow your analysis. Trading the market is a very risky business, like very, when I mean risky, is very risky. So there is a very high likelihood that you're going to make losses more than you will make profits. Meaning, if you started with $1,000, the probability that you will end up with less than $1,000 at the end of the trading period, maybe a month, a week, or a year, is higher than the probability that you're going to end up with something above $1,000, let's say $1,100. And the reason is because the market could be a very chaotic place. The market could be a very unforgiving place. Like I keep saying, trading is a zero-sum game. And by zero-sum game, it means that zero-sum is a zero-sum, sum S. It's a zero-sum game. And by zero-sum, I mean that the system doesn't generate more money. Okay, Lawal, I heard you. Let me make Joanne to. Joanne, please unmute yourself.
Where I am, sir, it's noisy, so I won't mute myself back.
Okay. Lawal. Okay, so the zero-sum game means that the entire system doesn't generate new money. What it does is that it takes money from a good trader or a patient trader that knows what he's doing and transfers that money to the account of the impatient trader or the trader that cannot stick to his strategy, irrespective of what our strategy is. Once our strategy has been tested to show that, okay, it works, even if it's 60% of the time, meaning if you follow that strategy, 6 times out of 10, you're going to have winning trades. You might lose 4 trades, but then 6 out of 10, you will win. And if you can follow that strategy every time, overall, in the long run, you end up at the end of your trading period that you're reviewing, you end up with a profitable account. Now, because trading is a zero-sum game, there will be more losers in the market than there will be winners. It's just like your Bet Ninja. Maybe Bet Ninja is extreme, but Bet Ninja is the closest I can give. So Bet Ninja, for example, if 100 people bet on a game, most likely, maybe on a game that has many odds, most likely out of 100 people, only like 10 would win. And only like maybe 2 will win crazy amount. When I mean crazy amount, I mean those who turn 10,000 naira in their betting account to like 1 million naira. Maybe only like one person out of 100 or even out of 1,000 will have that kind of result. So if it turns 10,000 into 1 million, where does the other 1 million naira that is making comes from? It comes from the losses of all the other people that bet the same 10,000 but that did not win anything. So the trading environment is similar, but the trading environment is a little more advanced because if it's a betting game, for example, you bet that Leicester or Arsenal, sorry, Chelsea will win Leicester United or Leicester Football Club. That's your bet. At the end of that game, the bet is over. But in the trading environment, you can bet that okay, Bitcoin is going to go up, and then you can remain in that bet for the next 2 years or 3 years or 4 years or 5 years, depending on how long you decide to hold the trade. Do you understand? So if you bet that Bitcoin is going up and Bitcoin keeps coming down, it means that perpetually you will be in a loss until you either decide that I'm tired, this thing keeps going down, and you cut your losses and move on, or you wait it out until Bitcoin eventually turns around and starts going up. So what makes it difficult in trading is that all that while you are waiting, the market will turn and start going in your favor. There's a lot of thoughts going through your mind. Some thoughts like, what if it goes to zero? What if I lose all my money? Oh, what if I become broke from this market trade I entered? So all that thoughts can cloud your judgment and cause you to make errors. Errors that will lead you to make losses. Losses that maybe if we are just patient and left Bitcoin alone, in the long run, it would have reversed. You understand? So risk management in trading therefore helps you reduce the losses that would have happened to your account in case your analysis was wrong. For example, part of risk management includes stop loss. Lawal, where you are is still noisy. Let me mute you. I don't know that sound that is happening. So I'll just go on. If there's anything, just type in the chat box. So let me share the screen now. Okay, and what is position sizing? Position sizing is how you allocate your trades. Like I said, it's a part of risk management. You can say, okay, I have $1,000 in my account. I don't know which trades will be the good trades and which trades, I don't know which trades will be profitable. I don't know which trades will be extremely profitable, extreme, and I don't know which trades will be losing trades, and I don't know which trades losing, and I don't know which trades will be extremely losing trades. So I don't know. So I can decide that out of this $1,000, I'll break my trades into $100, meaning 100 times 10 gives me 1,000. Meaning if I'm going to take 10 trades, I will take them only with $100. So that if I lose one trade of $100, I still have $900 left that I can enter other trades. So that is position sizing. Then what is portfolio management? Portfolio management simply means if I'm holding so many coins, maybe there's ADA, in the cryptocurrency market, there are lots of coins, many coins. It can even be confusing just to even decide which one you want to trade. So portfolio management now becomes a serious thing. There are coins that are in DeFi. We'll talk about DeFi before this week runs out. There are coins that are under DeFi. There are coins that are NFT. There are coins that are based on blockchains. Do you understand? There are coins that are blockchain. There are coins that are privacy coins. There are coins that have to do with marijuana. So there are coins belonging to different niche in the technology space. So do you understand? So you now decide, okay, when DeFi when DeFi is moving, most times all the DeFi coins move together. Example is Aave, Compound, Link, uh, and so many others. They tend CRV, they tend to move together. NFT tokens too. When is NFT season and NFT coins are going up, they tend to go up together. So now you're managing your portfolio will now tell you, okay, how much will I allocate to each of these different sectors? Why? Because it doesn't make sense to just park all your $1,000, do you understand? And just put in coins that you don't even know what they do or in what niche of the market that they belong to. Another thing about managing your portfolio is, okay, I entered a trade at $1,000, but I entered three trades at $1,000 with $300. So my $1,000 is gone, is into coins, different coins. And now some of these coins are going up, some of them are coming down, and Bitcoin is looking as if it wants to go down. And we all know that when Bitcoin starts going down, most times other coins are affected too. So it now requires me to do portfolio management to say, okay, out of these coins, one is in profit, one is in loss. Let me close half, let me close 50% of this one that is in profit. Let me close 75% of this one that is in a loss. Let me close 100% of this one that has not moved at all, that is just within my buy area. Let me close this one. Why? Because if Bitcoin keeps going down, I don't want to be in deep losses and not have any USDT on the side that I can use. So that is what is called portfolio management. Now, let's go to the chart. Okay, okay. I actually think Bitcoin is done correcting. Like I showed you guys on this chart, this is what I'm expecting. Once we see this happen, then be rest assured that Bitcoin is done. Not be rest assured, at least there's nothing like rest assured in trading. Be at least 60%, there's a 60% probability that market will start going up from here. If you've been following the channel, I drew this since, I think I drew this from here. That was around 1 p.m. in the afternoon, and this is 8 p.m. So if market follows this, then it means that Bitcoin is actually tired of going down. It wants to give altcoins room to move, but you don't just jump in. You wait for a confirmation. The reason to wait for a confirmation is so that you have confidence in the trade based on your plan. Now, on risk management, let's go to Ethereum. Okay. I wanted to use this because some weeks ago, that was in early May, I drew this thing that, okay, once Ethereum had broken out here, I think it was around here, and I drew this chart. Okay, now, as part of your risk management, you should have a stop loss. Now, there are two kinds of stop loss. There's a hard stop loss, hard, Hard, and there's a mental stop loss. In your hard stop loss, you're saying that, okay, if I buy Ethereum at $3,600, I'm going to put my stop loss at, let's say, 10% away from my entry. 10% away from my entry. Meaning you're saying that if I buy Ethereum with $1,000 and at 3,600 and market drops to, let's see, market drops from here to 3,300. That's about a 10% drop that you want to be taken out of the trade. So it means you're saying in advance that, okay, this trade I'm entering, I'm not sure how far up it will go, and I'm not sure how far down market can reverse against me. In order not to panic or be in fear, I have agreed ahead of time that I am willing to lose 10% of my money on this trade. So if you enter this trade with $1,000, your stop loss is at 10% away from your entry. You're saying that I'm willing to lose $100 on this trade if the analysis doesn't play out. If something happens and the analysis is wrong, I don't want to be panicking and jumping in and out of trades. I just want to sit down and allow the market to prove me wrong by actually coming down and hitting my stop loss. So once you've done that, then it reduces the fear of losing. There's something called the fear of losing. The fear of losing is powerful. It will stop you from trading properly. It will stop you from following a trade. Why? Because you are afraid that what if it's a loss? So the only way to tackle the fear of losing is to agree ahead of time that there's a probability that this trade could be a losing trade. So you tell yourself, if this trade could be a losing trade, how much am I prepared to lose? And I'll still be comfortable. So you say, okay, $100. You now ask yourself, okay, in this trade, how much will I still be fine? Will make me a little happy if the market goes in my favor. You now say, okay, if I make 200 on this $300 on this trade, I'll be fine. So it means you're risking $100 to make, let's say, let's say the trade, the way it moved from here to here. Okay, that's 15%. It moved 15%. 17%. So you're saying, okay, I'm willing to risk $100 to make, let's say, $150 on this trade. Once you do that, then you are fine. You won't be panicking if the market is going against you. In fact, you allow the market to come down and hit your stop loss if you have a hard stop loss. A hard stop loss is the one that you actually go to your trading account on Binance and set a stop loss order at a fixed price. Let's say here 3,380. When price gets there, whether you're on the chart, whether you're looking at the trade or you're not looking at the trade, price will take you out of the trade and you have your $900 balance in your account. Meanwhile, your account will be down by $100. That's mental stop. But that's a hard stop loss. A mental stop loss is the one that you didn't enter a stop loss, actual stop loss in the market, but you've set it in your mind that once price gets to this level, I will not hesitate. I will wait. Sorry, once price gets to this level, I'll allow the candle to close and I'll get out of the trade. I will set alarms here. When price gets to this alarm level, I'll wait for the candle to close, then I'll get out of the trade. Now, the I'll now tell you the advantages and disadvantages of both. Now, the advantage of a hard stop loss is that once you set a hard stop loss, you go away. You can do other things and your mind will be rest assured that, okay, I'm only risking $100 on this trade. Anything that happens, I'm okay losing $100. So you go away, you're doing whatever it is you're doing. Do you understand? You're fine. That's the disadvantage. That's the advantage. Now, the disadvantage of that is there's something called spikes or flash crash, where market actually comes down with speed, gets to your stop loss, takes you out of the market, then reverses and goes the other way. For example, can you see this candle here? Can you see this candle here, this particular long one? Even see this one. That's an example of a flash crash. Market just came down with speed, took all the stop losses, but then went back up. See how far it went back up. So if your stop loss was somewhere here, you'll be heartbroken to see that, oh, market has stopped you out, then it has gone in your favor. Meaning this loss you took here would actually have been a profit if you didn't use a stop loss. So to set stop loss in crypto trading, you need to set good stops and give market a lot of room to move. Do you understand? So you set large stops, which is what I advise, because market can range, come to your stop loss, but eventually go in your favor. So now, okay, now let's look at the mental stops. Now, the mental stops, you don't have a fixed stop loss in the market. You only have a price or zone in your head. You tell yourself once market goes below this line and closes below it, I know that this trade is a losing trade. So whatever loss I find here that is within this percentage, maybe 10% that you have agreed on, I'll get out of the market. Now, the disadvantage of using a mental stop is that it means that you have to be watching the chart all the time, or it means you have to set alerts on the chart and be sure that those alerts will trigger, or even be sure that you'll be online all the time so that when the alert comes in your email or as a text message or as a vibration on your alert, TradingView alert, you'll be able to come online and do it. And we all know that we are humans. We get busy sometimes and don't even care about our phone or things that are happening in the market. That happens. So that's the disadvantage of a mental stop loss. But then the advantage is that it will save you. Okay, the another disadvantage is that sometimes you set, okay, I'm going to come to this area, then when price gets here, I'll come, then I'll manually close the trade. Another disadvantage to that is that sometimes price will just come down with speed and will just keep going and will just keep going and will not give you a time to even reorganize yourself and get out of the market. That's one disadvantage of using a mental stop. You know, it will just keep going down and won't give you the opportunity to get out of the market. But one advantage of the mental stop is that it saves you from spikes like this. For example, market went down, but then it didn't close below your level. It just came with speed, but eventually went back up. Like the candle, this candle did not close below here. It only wicked, that's what it's called. It wicked down, but then went back up. It didn't close below your stop loss zone. So using a mental stop loss will save you from those kind of things that happen in the market. Now, another thing we'll talk about is buy zone. And the concept of the buy zone is this: it has its advantage and it has its disadvantage too. Everything in trading has advantage, has disadvantage. Eventually, you have to choose one of the lesser evil or decide what to use in a particular market. This red area, for example, sometimes I like to call it a buy zone. Then beyond this buy zone, you have your stop loss. Now, if you're going to enter a trade with, say, $1,000, you don't just jump and put all your $1,000 at once, except it's a clear breakout. Like here now, this is a clear breakout. Market broke out of this zone. Do you understand? And you know that if you don't follow this trade, you might miss out. Even at that, you still agree that, okay, I might be wrong on this trade and I'm willing to lose this $100 that is my stop loss zone, that is beyond my stop loss zone. Then, but for using a buy zone, sometimes it happens in ranging markets where, okay, market has given you a signal, a signal to buy. Let's say buy here. But then sometimes you know that market will range, come down, go up. So instead of entering here with all your $1,000 that you want to use on this trade, you can enter, let's say, $300 here, set a buy order here for another $300, set a buy order here again for another $300. So you now have an average of your entry points. So because your average is larger, your stop loss area can even go lower. Why? Because you averaged in. Now the advantage of this is that it gives you a lower overall entry price. Overall, you have a lower entry price. You entered here, you entered here, you entered here. Overall, you have a better price than someone that just bought everything here. Now, the disadvantage of that is sometimes you buy here, you set your limit orders here, the market just starts going up when you just bought one portion without filling in your other orders, the other orders that you set in the market. Another disadvantage is that, okay, now the advantage of this is that, okay, when market comes down, you have a better entry. Then when market decides to go against you, your stop loss, overall stop loss too, will be less or wider, depending on how you're viewing the market at that time. Now, that is how to use buy zones. Now, another aspect of risk management that might not apply to, there are different kinds of platforms. You have decentralized exchanges and you have centralized exchanges. Now, this example I'm giving, you can only use this on centralized exchanges like Binance, OKX, KuCoin. These centralized exchanges have facilities where you can set stop loss, buy limit, sell stop, buy stop. Do you understand? They have that facilities. So you can use this strategy effectively. But if you are using a decentralized exchange like maybe PancakeSwap or Uniswap, you cannot use this kind of strategy. Why? Because you cannot set stop loss on PancakeSwap. You cannot set stop loss on Uniswap. So the way you manage risk there is by position sizing. Position sizing in the sense that you have $1,000. You can now say, okay, I'm buying this coin on KuCoin. I'm buying this coin on PancakeSwap. I want to risk $500 and I'm willing to lose maybe 20%, which is $100 if market goes against me. But then there's no facility for setting stop loss. So what does it mean? It means you'll be monitoring the chart often, and that can be stressful. So what do you do instead? You now say, okay, instead of risking this $500 on a place where I cannot set stop loss, which means that there's a very high possibility that on PancakeSwap, the whole price can just drop and my $500 will go as low as, let's say, $100, meaning I'll lose 80%, or maybe go as low as $200, meaning I'll lose 300%. Sorry, meaning I'll lose, is that 60%? No, meaning I'll lose 80%. Is that 80%? Sorry, my math is not forming well tonight. So instead of doing that, you can decide that someone said you can go as low as $10. Yes. So instead of risking that whole 500, you can now say, okay, I'm not prepared to risk all this 500 because it can go to $10. So instead, let me put in the $100 that I'm willing to risk. If this $100 goes to $1, I won't cry. I won't feel bad. What have you done? You've done what is called position sizing, which is an aspect of risk management. Some people say, okay, what if I put in the $500, and market just does 10x and I have $5,000? I'll be feeling bad and wishing I had put in, sorry, market would have given me $5,000, but instead I only put in $100 and market did 5x and instead I have only $500. instead of having $2,500 and now have only $500, I'll be feeling bad. So the question now means, is profit not profit? Profit is better than loss. Small profit is better than small loss. So instead of exposing your whole $500 to an exchange where there's no stop loss, where you can lose everything, why not put the amount that you are willing to risk? Now, what I'm teaching you guys is the only way you can trade and sleep well at night, knowing that, okay, even if this $100 goes down, I'm fine. If if you don't do this, you find yourself waking up in the middle of the night to be checking phone or to be very uncomfortable. And you don't want that. You want peace of mind. When you have a little peace, you can see better opportunities in the market. The market can speak to you. The market speaks. The market can speak to you. Some people call it, some people say it's God that told them to buy a coin. Maybe it's your mind or whatever. But then you will be in a better frame of mind to take care of opportunities. And this way, you're playing the long-term game, because the first rule of your trading is preserve your capital at all costs. Preserve it. Because if you preserve it, there will be many opportunities in the market. But if you don't preserve it and you lose everything, getting a new capital might be hard, and taking away that psychological pain that you are a sucker, that you couldn't even stick your plants, can be very high too. So it's better to play safe and play the long game than to want to put all your money in one coin because Mr. Ken called it that is going to give you a lot of money. Mr. Ken does not control the market. This is based on probabilities. Even Elon Musk that is tweeting, he doesn't control the market. At least for now, the market is way big. Do you understand? He can only have temporal effects, but the long-term impact of just one person on a market that is worth $2 trillion, it will be short-lived. Do you understand? So that's position sizing on an exchange like Uniswap or PancakeSwap. Now, what of portfolio management? Portfolio management is that, okay, I have $1,000. Now, I have an account on Binance. At the same time, I don't want to miss out on all the shit coins on PancakeSwap. So what do I do? I analyze myself to say, okay, PancakeSwap has more risky coins. And the riskier a coin, sometimes the higher the potential ROI that the coin can give. The higher the potential ROI. There are coins on PancakeSwap that can turn $10 to like maybe $10,000. But you cannot find those coins. It's rare to find those coins on Binance. Do you understand? The same way there are coins on PancakeSwap that can turn your $1,000 to $1. But it's rare. It's not a frequent occurrence to see coins on Binance or on big exchange that will turn your $1,000 to $1 without hope of it going back up. On PancakeSwap, some coins, once they go down, they've gone down. They will never rise again. So, and you want to play in both markets. You don't want to miss out on the action on PancakeSwap, which is risky, which is more risky. At the same time, you don't want to commit all your money from Binance into something that risky. You cannot say, okay, out of my $1,000, let me split my portfolio into maybe three. I'll hold $600 for coins on Binance with solid use case. $600. I'll hold $200 on new coins on Binance, new coins that have potential to go up, that I know that they can also go down. I'll have $200 in those coins. Then $200, I'll take it to PancakeSwap and maybe put any coin I research and I see that it's doing well. Maybe I'll just put $50 in it and see if it goes to 5x. If $50 goes to 3x, I remove my $50, I'm left with 100. If that 100 goes to $200, I remove another 100, I'm left with 100. Then I leave the rest to see what it will do, whether it will take me to the moon or bring me back to zero. What are you doing? You are managing your portfolio. Then you now take it to the high level of portfolio management when market is going up in your favor and when market is going down against you. Now, when market is going down in your favor, the first bag that you had that has $600, let's say this one has now grown to, let's say, $1,200. The other one that had $200 on Binance too, maybe it moved faster. This one now did 5x. Let's say it grew to $1,000. Then all these shit coins that you have on Binance that had only $200, let's say they've grown to like $2,000. So in all, you now have 2,000 plus 1,000 plus 1,002. That's 4,200. 4,200. You now enter the next phase. Okay, it's time to rearrange this portfolio. Let me rebalance. So this one that gave you 2,000, you still know that it's very risky. This 2,000 it gave you can still go to $20 if care is not taken. So what do? You rebalance. You now say, okay, now I'm going to take out $1,500 from here, put it into this one that has more stable coins, plus 1,500, leave $500 in this one, in these shit coins. This 200 that became 1,000, you can say, okay, let me take out 2 or 300 or 400 from here. Put it on the next section. Do you understand? This one now has more money as usual. This one has more money. This one has more money than this, because you always want to be maintaining the ratio. The stable coins have more of your money. The stable and older coins have more of your money. The newer coins have a little more of your money, but not up to the first one. Then the shit coins are more risky, have the lowest of your money. So you're always rebalancing it at all time. Now, let's now do rebalancing, and you can set the ratio. You can say maybe 60%, 20%, 20%, 20%. So you try to maintain it at all times. So you can say 50%, 30%, 20%. So you maintain this ratio at all times, and you can say, okay, every two months I'll rebalance, every three months I'll rebalance, every two weeks I'll rebalance, depending on how fast each of these one is moving. Sometimes some will move more than others, but then you can now be rebalancing it quickly. Now that is rebalancing when market is going up. Now, how do you rebalance when market is going against you? Now, when market is going against you, like we have Bitcoin going bearish, you can now say, okay, I had 600 here initially. I had, let's say, okay, no, let's say I had 500 here in the first main account. I had 300, then I had 200. Now, I've bought some coins. These coins have now gone down to 400. Should I still keep holding these coins? Have they hit my stop loss or what? Have they gotten to my mental stop loss area? If yes, you cut your losses short, you get out. You admit that, okay, based on my strategy, I have lost 20% in this account. So you have 400 left. Maybe this account even went down more. Do you understand? Maybe instead of losing $300, sorry, instead of losing 10%, here you lost 20%. Let's say here you're losing 30%. So here you're down to 30% is 270. You're down to 270. No, no, that's not 10% is 30. 10% is 30. 30, 60. Okay, you're down to 210. You're down to 210. You're down to 210. So you're down here, you're down here. But this one, because they are shit coins, maybe they've given you $1,000. So you now add everything together. Overall, you are still in profit. So instead of feeling bad that you've lost money here, you've lost money here, this one has balanced it out. And you know that the way Bitcoin is looking, it might go down more. What do? You move into USDT straight, you are still in profit. Now you are waiting for the dip. Or sometimes market might go down and then you're trying to get out, then it just moves back up. So you might not get out completely. You might say, okay, I'm going to reduce 50% of these altcoins and hold USDT. I'll reduce 75% here and hold USDT. This one, I'll move 70% to USDT. So you now have less exposure to the market. You now have enough money in on the side. You are now waiting for market to give you signs that is going to go up. The way I'm seeing Bitcoin is giving us signs. So all this money you have on the sidelines, when market has gone down, has given you confirmation that okay, we have gone down, we have formed a bottom, we tested that bottom, now we are heading high. You wait for the confirmation, which might be somewhere here. You enter your altcoin positions, then you ride the wave back up. And as you're riding the wave back up, any profit that you have, any loss that you made here before, you're going to make it back. But being on the sidelines gives you more peace of mind. I know a lot of people holding altcoins, a lot of altcoins right now, are not smiling. They are in severe pains. And the reason is because they don't have a clear strategy for taking profits. Some of them don't even know how many altcoins they have. Do you understand? You shouldn't be that way. It's a business. So have a record that you check every week. You rebalance it. Okay, I'm holding these altcoins. I'm holding these altcoins. If for your short-term portfolio, if you're looking at long-term, put your coins in one wallet that you don't even care about. You don't check it for any reason. Do you understand? So that's how to play the game. I thought I'll be able to cover those other two things, but